Hey guys, Ben from Pivot Wealth, and today I'm bringing you money news in human words, where we're going to be talking about the new first home buyer scheme initiative from the government, where people can access their super up to $50,000. The massive sort of downturn in markets over the last week and what's driving that, as well as the crypto markets and the battering that it's been copping, as well as some of the opportunity that's out there as well. So, look, the first thing that I think investors need to be across at the moment is this new initiative. Welcome news from the government around using superannuation to fund your first home. Now, the government have come out and said that you can use up to $50,000 of your super money or 40% of your super fund balance to fund your first property deposit. That's per person, which I think is important. It essentially gives you up to $100,000 to use as a deposit if you're part of a couple. Welcome news for first home buyers off the back of the property price rises over the last year and a bit. One thing that is unclear at this stage, based on the information that they've put out, is around how that might work with the existing schemes that exist, where you've got the first home super saver scheme, where you can access up to $50,000 of your super to buy your first home for extra super contributions that you put into super. Now, potentially, if those two work together, you could be accessing $50,000 under the new proposed scheme and $50,000 under the existing scheme, potentially up to $200,000 as a couple, which is a big chunk of your first property deposit, if not all of it, and a little bit more. So, look, I think, it's really one to watch. It's obviously important because it helps people to get into the property market sooner. I think even if you already own property, it is going to have some impact on property markets, and there is a bit of talk out there about this scheme potentially further inflating property prices, which is a potential issue off the back of the big rises that we've seen. Although with the cooling market, and I suppose the number of first home buyers, the first home affordability, I suppose time will tell what the actual impact there is. Now, this I think is important to be across, because the reality is that for most people, buying property is one of the biggest and most important moves on their wealth building journey. So the sooner you can make that happen, the sooner you get into the market. And then you've got this big asset that's working for you into the future. I talk to a lot of people about their money, and people in a range of positions from not so good to really good. The ones that are doing better are the ones that got into the property market sooner. There's obviously a bit of talk as to whether the property market will continue to rise at the pace that we've seen. But given that we've got strong population growth, income growth, productivity growth, and all those sorts of things, I think it's probably going to be something in the future is going to look something like the past there. I think the actions here, maybe vote Liberal. I suppose it depends on which way you're inclined there. But potentially a really good one. Labor have not backed this policy, so it is something that would be implemented if Liberal get into power in the election. Whether it actually happens, though, or they can get the votes to actually get it through, that's another whole thing. So I suppose time will tell. But when the detail comes out of this thing, if it does come through, keep a really close eye on that and make sure that you're set for making the right moves for you. Given the opposition to this initiative, it's possible that even if it does get put in place, it could get wound back at some point. So if it is going to be right for you, make sure you put yourself in a position to take action and take advantage if it is the right move for you. Another interesting thing that I've been looking at over the last week, interesting / painful / frustrating / exciting, is the China lockdown and the impact that that's having on markets around the world. They've got this hectic COVID lockdown over there at the moment. I think a lot of people are seeing those images, people cooped up in their houses and not allowed to leave for any reason at all. I know for me, I was struggling when I could only, wander around Blackwattle Bay for 2 hours a day and, go to the office, go to the shops, do the things that I needed to do. Heart goes out to those guys that are stuck in much more severe restrictions. But aside from the personal cost, this is having a big impact on economies and markets. The economies in China, and that is rippling through the rest of the global markets. China is a big net importer of a lot of goods, and the fact that everyone is locked down and they've got trade restrictions on it's stopping people from being able to buy the same goods. So the US is getting impacted. That's having a serious impact on their share markets. Europe is the same. A lot of other countries. So yeah, it's a huge driver of what's going on in the markets, and we've seen the markets copper battering over the last week and a bit. So, look, I think that this is important because whatever happens in China is going to impact global markets throughout the rest of 22, and how quickly they recover and turn this situation around, which I'm confident that they will in a matter of time. But how quickly they do it is going to be a big driver of what investors can see in markets over the remainder of this year. It also creates an opportunity for investors, I think, around investing in companies that have been most severely impacted from this COVID, from the China COVID lockdown. These investments are essentially on sale. The Chinese government does seem really committed to getting onto the other side of this. It's just a matter of when, in my opinion. So I think the actions on this one is know whether you're take the time to understand whether your investments have been impacted and how, and whether you're in a position to take advantage of some of those companies which are good buying at the moment as a result of this disruption. Another key area that I've been looking at over the last week is the crypto market meltdown. I think, along with everybody else, it's been crazy to see Terra Luna, a lot of value being wiped out there. Literally, like trillions of dollars of the markets declining, and even the blue chip, like your Bitcoins and Ethers and the bigger coins, have been impacted. The smaller coins have been impacted potentially even more. Bitcoin now down over 50%, and some of them, significantly more than that. Now, crypto, I think this is important because crypto is impossible to ignore at this point. Many investors, though, have been riding the wave over the last little while, and these investors are now feeling the pain of the down market. But I think the opportunity here, and I was reading an interesting article talking about the bigger boys in town, the fundies that are in the crypto space, and now essentially queuing up to get back into the market and picking up some assets which were, not very long ago priced at much higher prices, which seems like, if you've got a positive long-term take on crypto, there's some serious buying in the market at the moment. So actions on this one: plan smart and take action if it makes sense for you. These market conditions do change really quickly when it comes to crypto. So if it is part of your future, you don't want to be sitting on the fence when the market moves again. Another piece, and continuing with the focus on markets over the last little bit, tech shares have had like over $16 trillion of value wiped off over the last week alone. And markets are under a heap of pressure. This China situation, lockdown, Russia conflict, the interest rates, inflation data, it's driving a lot of uncertainty, a lot of fear from investors. As a result, a lot of people are seeing a significant amount of the value of their investments being wiped off their holdings. This, I think, tied in with a lot of the noise and media hype that we're seeing out there, is leading to some serious elevation in stress levels for investors. But look, the opportunity really is that if you've got a long-term view, all of the shares that you would have bought last week, all the ones that you have in your portfolio, they're now all on sale. So you can pick them up for a price that's significantly less than what you would have paid, not very long ago. So the market dips at the times when you can make some serious bank from your money. And it's that thing that downturns make millionaires. It's a big thing from a lot of successful investors. And if you look back over time, a lot of people that have big money have made a lot of that money by investing smart in the downturn. So the actions here: be smart, keep your head, make sure your investment strategy and actual investments are rock solid. Then you can ignore that noise and the market commentary and laugh all the way to the bank. My last piece that I wanted to cover this week, I was looking at this article from this like super successful investor that manages about $15 billion in assets for investors. This fund management house had picked basically a couple of the significant market downturns in 2008 and 2001, and they, super proud of this track record in doing that. This investor was a big, doomsday advocate, talking about the fact there's going to be this huge bear market and investors are in for all of this pain. I think that, this matters because it can lead investors to panic and make investment decisions, follow that herd mentality, and make bad decisions. And it's hard to make sense of all of the noise out there. I think that the other thing to call out is that, this particular investment manager, that they're selling a solution that that does well when the panic exists. So I think that it's one thing to predict a bear market, but it's one thing to be selling a solution that has people set to essentially profit in a bear market. And getting a ton of benefit out of that. And this investor, that they had underperformed the general share markets, the S&P 500, I think they compared it to by 20% over the last 5 years. When markets are going good, they miss out on all of that upside, but they do protect against the downside. And look, whether there's a bear market or the markets go flat or they go down or they go up, I think if you're taking a long-term view and you've got a lot of time on your side, you can ride out all of those waves. And trying to be too cute and pick the markets or protect a downside means that you're giving up all of the potential upside. And that's really, really costly if you've got a lot of time on your side. So, I think that the key here is that if you're a net buyer, be happy that your investments are now on sale. Obviously, a bit of pain that comes from existing investments, but know that the markets are the markets. And if you're investing in the market, all you need to be backing is that good companies will make good money over time by doing good business. And I think that's something that will continue in the future, so long as our existing financial market structure remains the same. So I think, understand that these conflicts of interest can impact the commentary that's coming out there, and look at those vested interests before you start freaking out too much. If you do that, you're well placed to get the best out of your investments. Guys, I hope you found that helpful. If you've got anyone in your network that think would benefit from this, feel free to give it a share around. Cheers, team. I'll catch you next.